Are US tariffs about to completely obliterate the Canadian mortgage market? With talks of potential 25% tariffs on Canadian imports, as well as the already implemented 25% tariff on aluminum and steel worldwide, I've been getting a lot of questions about this. People asking, should we take a variable, should we lock in, or should we just not look for a mortgage at all at this point in time? It's a lot of interesting news, it's a lot of things going on, and some of it's in a really negative way. So today I'm going to try and break this all down for you so you can understand how these tariffs can affect Canadian mortgages, be it fixed or variable. Hey everyone, Myles Nowik here from the Nowik Mortgage Team, powered by Indie Mortgage. Welcome back to the channel. Today we're diving into the potential effects and impacts of US tariffs on Canadian interest rates, and more importantly, how it could affect your mortgage payments. Whether you're a variable rate or thinking of locking into a fixed rate or just trying to make sense of all of this economic chaos, we've got you covered. So let's dive into this. There's been a 25% tariff put in place for steel and aluminum. That's really going to affect Canada as we supply a ton of it to the United States. On top of that, the US administration is threatening 25% tariffs on Canadian imports. We've talked about this in greater detail in a couple of other videos, but just the threat of them is already shaking things up. Markets are reacting, businesses are getting nervous, and the Canadian dollar is feeling a lot of pressure and kind of nosediving. The Bank of Canada isn't really addressing these or factoring them into their official forecasts just yet, but they know they're a major risk and they know there's something they need to pay attention to. Now, what I want to touch on here is really how this is going to affect interest rates and how it could affect you. Right now, inflation is hovering about 2%, and economic growth is not great, but steady. That's allowing the Bank of Canada to continue cutting interest rates. But tariffs, they could throw a wrench in this plan. And here's how. First, we're going to talk about scenario one, with inflation going up based on these tariffs. If tariffs drive up the cost of raw materials, cars, and consumer goods, we could see inflation spike. In that case, the Bank of Canada may have to hit the pause button on rate cuts, or in a worst case scenario, even hike them to keep inflation under control. Now, when we talk about inflation because of these tariffs, one thing I try to keep in mind with this is we're not paying higher prices because we have disposable income or excess cash flow. It's because the cost of that good is going up based on external sources, being the US tariffs. So in that case, raising interest rates to combat inflation, it just seems very different from the previous increases to prime that we've seen on this last rate cycle. In my opinion, I think they'd more so keep things stable, pausing the cuts versus actually hiking the interest rates up. Because the Bank of Canada really has two jobs. One, combat inflation, and two, make sure our economy doesn't implode. So it's a bit of a fine line, but I could definitely see them holding rates if inflation goes up like crazy. But I think it would have to go a little bit past crazy if they were to start hiking them back up again. Now, for scenario two, we want to look at economic slowdown and lower interest rates. So on the flip side of this, if tariffs scare off investment and hurt consumer spending, the economy could slow down to a halt. And this would likely push the Bank of Canada to continue cutting rates to stimulate that growth further. And once again, the reason for this is, the goal of a country is to have a thriving economy, really. You don't want to be the country that's like, oh, our goal is to suck. No, we want to have a thriving economy. We want to have economic growth. And when we look at things statistically, usually when things like this happen and money gets tight, Canadians tend to hold on to their cash. They hold it close. They don't spend as much, which hurts those businesses, putting the bank in a position where they have to stimulate that economy to keep the economy growing and being robust, in which case they cut rates. So really, right now, the Bank of Canada is playing the waiting game, watching how things unfold before making any big moves or decisions. And they're definitely not going to openly talk about it in their press conferences and give away what they're thinking because they don't want to create panic and they don't want to give false narratives as to what's going to happen. The big thing we talk about with this is the impact on mortgages. As a mortgage guy, that's kind of my bread and butter. That's why I'm here. And when we talk about it, if you've got a variable rate mortgage, you're likely going to feel any Bank of Canada rate change directly. If rates keep dropping, that's great. If you're in a static payment, you're going to see more money go towards your principal. If you're in an adjustable rate variable, you're going to see your payments decrease, both options saving you money in one way or the other. On the flip side, if the Bank of Canada is forced to pause or hike rates due to inflation, your payments could stay the same or even increase. Now, the big question with this is, what type of variable rate mortgage do you have? That is something that is crucial to understand because there's two types. I've talked about this a couple of times. I'm going to talk about it again because I think it's really important. You want to make sure you're in an adjustable rate variable mortgage. And the reason for this is with the adjustable rate variable, your payments go up and down with prime. So if they jack prime up, your payments go up, you're still paying your mortgage off on time. But if they go down, your payments go down. However, you can take advantage of prepayment privileges to keep your payments the same, to pay it off faster, to get the benefits of the static payment if you wanted to. However, with the static payment variable, you don't have a choice. Your payment just stays the same until you hit a trigger rate. And to be honest with you, I don't think they're really enforcing these trigger rates. I recently saw an application. Guy's been living in his house for 15 years and his amortization was 25. He started at 25. He had literally not paid his mortgage down. He set himself back 15 years because of this static payment variable mortgage and not hitting the trigger rate to increase his payments or make lump sum payments to get him back on track to paying his mortgage off. This created an opportunity for payment shock and all these other nasty things that could easily have been avoided if he had an adjustable payment on this mortgage. Now, the big question is fixed or variable. Really? I mean, there's so many big questions with this, but the big one is fixed or variable. Do I take a fixed or do I take a variable? What I think you should do is really assess your comfort with risk. If you're comfortable riding out short-term uncertainty, staying in a variable rate could still be really beneficial since rate cuts are still on the table. They're still on the horizon. We still think we're going to see cuts by the end of this year. However, if you're going to lose sleep with that, and if you prefer predictability and stability, locking into a fixed rate might be worth considering while they're still relatively low. We have seen a decrease on the fixed mortgage side of things. We've seen the rates go down. They're actually quite good right now. You could do a switch transfer to another lender to access lower rates. You could simply lock in. You can refinance, whatever you need to do to access that lowest possible 5-year fix, 3-year fix, or whatever you're looking for to keep yourself comfortable. Now might be a very good time to do that, keeping in mind that if rates go down further, to access them, you're going to have to pay a penalty. The bottom line of all of this is that the market is really unpredictable, but staying informed gives you an upper hand. My goal is to keep monitoring this situation and to share as much information and detail as possible so that people can make educated and really good decisions based on what their goals are and what you want to do and how you want your mortgage to roll out. You really want to see both sides of the coin. You want to see the fixed versus variable. You want to see the adjustable versus the static. All these different things, and understanding these are what's going to allow you to make the right decision with your mortgage so that you can weather this potential tariff trade war storm. You just want the information. And if you want more information like this, make sure to hit that like and subscribe button and hit that bell so you don't miss another video. Now, if you found this helpful, drop a comment below with your thoughts on this. Are you team variable or team fixed? And once again, please don't forget to hit that like and subscribe button so that more people like you can see this video. Thank you so much for your time. If you need some personal advice, my booking link's down below. We'll catch you on the next one.